COVID-19 pandemic has affected millions of lives globally and brought with it a great deal of uncertainty and risks to economic growth. At the same time, it has also put industries in the position to face and embrace new challenges. In the eye of a pandemic, rebooting the Indian financial services sector, a leadership series by Refinitiv, partnered by ET Now, is bringing together the industry's leading voices to address key questions surrounding economic recovery and the role that the banking and financial services sector will play in it. To discuss financial institutions and the framework of their digital services under the pandemic, Aniruddha Chatterjee, market leader, account management, South Asia from Refinitiv, spoke with Vinay Matthews, founder and COO Fairsend, Lizzie Chapman, founder and CEO Zest Money, and Nand Kishore Purohit, head digital and distribution, HDFC Securities, on the topic Technology and Innovation, Rise of Digital Financial Services.
If you look at the last 5 years, we have seen the digital financial services providers have really evolved and scaled to a new height. What do you think are the consumer needs that digital financial services already addressing or has the potential to address?
The problem that you're trying to address is there is a very small percentage of people in this country get unsecured loans. So if you look at the data point, 2.5% of the people, or a little bit here and there, 2.5% of the people hold credit cards. That's way too less from the context of Indian economy. So clearly, the problem is the credit is reaching out to a very small percentage of the people. Okay. Now the other problem is trying to understand what is it that the banks and the NBFCs aren't doing. Okay, so one obviously is the speed at which they are able to lend, and second is the access, or is there a smarter way to kind of lend, and the other point is that how cheap they are in terms of lending. So one side is how fast you can do the lending, and the other side is that from an interest rate point of view, are you able to kind of drive that at a cheaper rate? So that's one side of the question. But the other side of the question is that why is it that they're not doing it? Okay, and that's what we try to answer. Not trying to figure out what is the gap that the banks and NBAs are creating, which we can fill, rather than figuring out what is it, why is it that they're not doing it? And the reason that we figured out is that from a cost point of view, it doesn't make sense for them. Okay. And that is where you introduce technology.
Collecting the digital crumbs can help build credit scores for the folks who may not have a credit score as of yet. So tell us about this and how this is impacting the consumer.
One of the key data points that we have in a platform like ours is end use of funds. And that means that over time, using the kind of refined machine learning models that we have, we can actually have a very elegant and accurate way to systematically determine the risk of this customer purchasing this item on this platform at this time of day versus a different customer purchasing a different item on a different platform. What we do is just use alternative data sets that have very strong and very common sense signals, and then we layer them on top of each other in the way that creates a sort of complex binomial tree that a human underwriter would never be able to assess as accurately as our machine learning models. So the purpose of using data models and ML models in underwriting is only to make the type of decisions a human used to make more quickly, more accurately, and more repeatedly with increased data. That doesn't mean that we are scraping secret information. In fact, we at Zest have a policy of not scraping data from people's phones. We think that that is actually not very consumer friendly, and that often customers don't understand the data that they give to different apps. So all of the data that we use in an underwriting decision is coming from the customer with their consent. We need to have a stronger framework around making sure the customer understands the data that they are submitting, and that it's being stored and used and processed in the most secure, safe, and ethical way.
It looks like there's a lot happening in the lending space. We can see, of course, the payment space trying to do many innovations, but What about insurance? I mean, we heard about digital insurance advisory. We heard about robo advisory in wealth. So tell us what's happening in the insurance and wealth space.
If I start with the wealth advisory, that's what the wealth tech is all about, and that's what the robo advisory is all about. So what was happening earlier was that wealth advisory was limited up to few high net worth individuals who were served by the relationship managers of a particular institution. And there was a man-to-man interaction in terms of understanding somebody's profile, be it the risk profile, be it the income expense profile, and basis that I provide him advice for his current investments as well as future savings. Our experience of 20 years in dealing with high net worth individuals has helped us to create AI ML enabled robo advisory platform, which not only brings in the technological advances, but also helps us to create plans, understanding, and build conversations to help the first time investors, the not so first time investors. So currently, this space is being disrupted with the help of our understanding of the customer behavior, with the help of understanding of our needs over last 20-25 years of our experience dealing with consumers, coupled with technological solutions, we are able to come out with a multi-asset robo advisory platform for our customers. Similarly, we are using lot of APIs, third-party people to create end-to-end digital financial plan for my customers, which would include all investment products, including protection like insurance. So it's a more of an engagement model which we have built to deliver wealth and protection solutions to our customers, rather than it's in a question answer model.
If I ask you to speculate for us, how do you see the next 1 year and 2 years going to look like?
There's no doubt that what's happened in the last 5 months has probably accelerated digital adoption by at least 5 years in this country. All over the world, we've seen customers rapidly accelerate their digital behavior. But anyway, in India, we are on such a fast-paced growth in digital adoption. So for us, it's something we always knew was going to happen, and we were kind of already there mentally, but we needed the ecosystem to catch up. And by that, I mean the retailers, the e-commerce partners, the payment gateway partners, and now finally the banks and NBFCs. And I think the biggest, most sort of transformational experience we've had in the last few weeks is every time we get on a call with a bank now, they finally say, we need 100% a digital lending product. So we are extremely optimistic long term, but we do appreciate short term, especially in balance sheet businesses. It's going to be quite a challenging time still. And that's why we think it's even more important that banks, fintechs, NBFCs work together to get through this sort of moratorium and risk period. We can bring our best practices as a digital lender to our bank partners to encourage things like, digital collections, digital restructuring of loans. All of these things are possible. So don't just think of the digital transformation as about how do we drive more lending, more volume, more acquisition. We also want to be here to help our bank partners do safer, more responsible collections, better servicing of their customers, and help them even in these more challenging times. So we're just so excited because finally everything we imagined is becoming reality.
So I look at it like this, okay? So some of the data points I want to kind of put out here. Twice as many consumers are shopping online today for groceries and e-commerce, okay? And many of them will borrow within that segment. Okay, Lizzie would be smiling right now. Okay, so clearly, that number has grown many folds in the last 2 3 months. Number of consumers that have moved on the digital channels increased by 20 to 25%. Then first-time digital consumers, has grown by 40%. Huge growth in the last 2 3 months. There has been a 13% growth in retail customers using mobile banking services. Again, impressive growth. And these are the growth I'm talking about the first 3 months. Okay, I have not accounted for growth for last month and for this month, which is going to happen. Okay? We are also seeing a lot of different interesting trends. Okay, For example, a whole lot of demand has moved online. Okay, we are seeing consumers kind of coming to kind of seek credit online. And the trend that we are seeing is that companies who will be able to build very smooth online digital journey for these customers, which is contactless, which is very smooth, without any collateral, no physical visits, quick turnaround time, very few documents, very cost effective, and very transparent, which is very important. Which means, at the end of the day, you're trying to create a underlining, IT infrastructure or an architecture which will tear down the socioeconomic walls. And this is going to happen the next 1 year.
We will entirely revamp our vision of customer journey. We will align our servicing model, both acquisition as well as servicing model, to become more digital, contactless. And we will align our entire front-end and back-end IT infrastructure and operations to service this contactless acquisition and servicing of the customers. We have already started that. Last 4 months, I'll tell you, people at our organizations have worked more than what they've worked in last 1 year. Because this 4 months have taught us a complete shift in our thought process. And let me tell you, we in our organization have more collaboration in last 4 months, because when you are pushed to the wall, you all come together to find a solution. So for a larger organization like us, where we have a lot of departments and each department has its own procedures, but this last 4 months have brought us together. We have collaborated well, and we have come out with solutions which otherwise we would have come out in years. So for us, it's a disruption. It's an internal disruption, if I may call or summarize in a line. So we have disrupted ourselves to be more aligned to the consumer needs.